Let's jump straight into the presentation. I have a few slides here, and I'll try and cover very practical case studies, cases that have happened in the recent past, and the potential tax fallouts of those cases, and how the structuring has been done in those cases, and what can be the takeaways for any similar kind of structurings that one may wish to explore. Before we get into the case studies, these are some of the themes, some of the recent tax developments which are likely to impact restructuring and which have also triggered certain restructurings in the recent past. Let's quickly recap some of these important developments that have happened in the last 1 or 2 years. First and foremost, there has been a major change in terms of taxation of repatriation of profits. We had a system of dividend distribution tax for several years, and we have now reverted to the classical system of taxation in the hands of the shareholders. An important aspect here is that when it comes to shareholders from treaty protected jurisdictions, there is a scope to lower the taxes even to the extent of taking a 5% tax rate position. And we've seen that some of these cases are presently or have also been decided by courts in writ petitions, where taxpayers had approached assessing officers for a 197 or a 195 certificate rather. And after the assessing officers denied those certificates, taxpayers went to the courts and they've got a favorable ruling, at least at the initial stage, stating that taxpayers from Netherlands, typically Netherlands, should be able to avail the 5% tax rate based on the MFN clause. So this is an important change which will impact a lot of restructurings going forward as well. Then buyback tax was introduced to cover all types of buybacks as well as buyback of listed shares. So we had seen a lot of listed companies going for buybacks in order to repatriate profits. Now that trend has gone down with the introduction of this buyback tax. Depreciation on goodwill was a very controversial topic, especially whether it's allowable in internal restructuring transactions, where it's a tax neutral merger or a demerger transaction. Based on Smith's, the Supreme Court ruling, taxpayers have gone ahead and taken positions in their tax returns that even those kind of mergers, tax neutral mergers, demergers, leading to goodwill in the hands of the successor company should be eligible for income tax depreciation. And we've seen that the budget last year has basically prohibited any tax depreciation on goodwill, not only on internal restructuring transactions, but also on purchase of business. So for example, if there's a slump sale or a slump exchange between two independent parties where the seller is paying full taxes, the buyer will still not be eligible to claim depreciation on goodwill. So we will see a lot of, we have also seen a lot of restructuring happen in the last few months and going forward as well, in order to bifurcate all the intangible assets that the purchaser buys, so that a minimal amount, if at all any, is allocated towards goodwill, and the consideration is split between tangible and intangible assets which are eligible for tax depreciation. Moving on to the third point, slump sale and slump exchange related amendments. Again, they have been introduced last year with some rules relating to fair valuation, of how to determine the fair valuation of an undertaking, which is the subject matter of a slump sale or a slump exchange, having been introduced again last year. Concessional corporate tax rate of 17% and 25% along with exemption from MAT. Again, this has led to a lot of restructuring in terms of companies wanting to form subsidiaries in order to expand their manufacturing presence in India. For HNIs, the tax rate, maximum marginal tax rate is 42.74%. This year's budget has given them some relief in terms of long-term capital gains taxes coming down, the peak surcharge rate being reduced. But still, it's a very high tax rate, and hence we've seen some sort of a trend in terms of either HNIs trying to move outside India or trying to form partnerships, LLPs, in order to run their family offices and make investments in various assets. Estate duty inheritance tax is something that we have been hearing for a long time. Nothing concrete that we are hearing from the government as of now. But there is always a fear that this may get introduced at some point of time, and hence some HNIs are also proactively planning for any potential introduction of an inheritance tax going forward. There have been changes in the capital gains tax regime as well, where deemed consideration on sale of shares has been introduced for the transferor. Earlier, there was a provision for taxing the recipient if the recipient pays inadequate consideration for purchase of shares. Now, a similar provision has been introduced for the transferor as well. There is also an introduction of a capital gains tax on sale of listed shares. And this has led to a lot of issues when it comes to IPOs and offer for sales and so on, which we will deal with in the next few case studies. If tax purview has been enlarged, it is now applicable to all recipients for receipt of specified assets. So earlier it was restricted to individuals, HUFs. For companies, partnerships, it was limited to a few assets. Now, all the taxpayers are basically subject to this gift tax levy. And last but not the least, there is an introduction of general anti-avoidance rule, albeit with certain administrative safeguards, but this will have an overhang on any kind of restructuring that is planned going forwards, given the wide sweeping powers that are given to assessing officers in cases where they basically are able to invoke GAR. They can recharacterize the transaction, and which can lead to a lot of tax related controversies and litigation going forward. So this is again an important aspect to bear in mind when planning for any kind of a structuring transaction. Let's look at the current trends or themes that we are seeing today. Some of these are again triggers based on the past, based on the recent tax developments. And most of these are, of course, commercial aspects that we are seeing in the marketplace today. M&A is at an all-time high. There are reports that last year's M&A was for India the highest in terms of deal making. These acquisitions, investments, again, Indian companies are stepping out and acquiring companies, deleveraging IPOs. There was a deluge of IPOs last year with the kind of liquidity easing that we saw and the capital market buoyancy. There were a lot of IPOs last year, and some interesting restructuring related themes coming from those IPOs we will see in the subsequent slides. India has seen a mushrooming of startups. We are third now currently on the list of unicorns globally after USA and China. So that is the kind of activity that we are seeing in this space. And the government is also doing its bit in terms of clarifying some of the tax aspects and providing concessions to startups so that they are able to flourish in India. The next theme is externalization. Again, this was a theme last year, and it will probably continue going forward as well, where companies want to shift their parentage from India to, let's say, US or any other overseas jurisdiction, which they think will have a better to which they'll have a better scope to raise funds, and where the investor community will appreciate the business model and the valuation in a much better way. So we have seen a few restructurings, and I'll cover one or two case studies around this as well. Legal entity rationalization in the form of mergers, demergers, collapsing of structures, be it on account of BEPS, treaty abuse related action plan, or generally in terms of reducing administrative costs and so on. We've seen that a lot of groups are undertaking this legal entity rationalization, where they are getting rid of holding companies, they are consolidating operations and so on. So which has led to a lot of internal M&A activity. IBC is another theme. Since the introduction of this code in India, we've seen a lot of companies wanting to acquire stressed assets. And there are some very peculiar tax issues to deal with when it comes to IBC. Shift of tax residency, again, this is because of the significantly high tax rate that HNIs have in India, where they are planning to shift outside India. And COVID basically has just accelerated that, probably because now they've seen that they can manage operations remotely, and hence they are happy to stay outside India, manage their operations, come on visits to India whenever needed, and plan their residential status in a manner that they don't pay significant taxes in India, especially if they are looking to exit a year or 2 years down the line, the tax rate for a non-resident is much more, it's much lower as compared to a resident. And hence, we are seeing this trend as well. Family settlement, succession planning, again, this we've seen across the board where families want to plan their businesses better in terms of which business will be run by which branch, and how does inheritance tax, how does people moving in and out of the country, all of that impact the business model, and hence what's the logical and most efficient way to structure their businesses. With this backdrop, I'll move to the first theme in terms of the case studies. The first theme is listing, and as we discussed, there was a deluge of IPOs last year, and if we look through the sequence of events leading up to the IPO, we will find that a lot of planning, a lot of restructuring is involved when it comes to going for a listing. Typically, these are the areas which are enlisted on the slide. These are the areas where there is a tax input along with the commercial aspects of unlocking value and consolidating businesses and so on. So the typical restructuring that is involved is segregation of loss-making businesses prior to IPO, where you don't want that to dilute the value of the company to be listed. So you would want to segregate a loss-making business outside the entity to be listed. Legal entity rationalization and optimization of tax attributes within the group. So for example, if a group has 2 or 3 subsidiaries under a holding company, some are profit making, some are loss making, it makes sense to merge those entities so that you have a single unified structure for listing. It becomes a simple structure. Investors appreciate it much better. And at the same time, you also have tax benefits in terms of utilizing losses of loss-making entities against the profits of the other entities. Then carving out non-core activities and assets, for example, real estate or treasury, where typically you don't get a valuation in an IPO process for these assets. So if there are surplus assets or if there are non-core activities, it's ideal to carve them out of the entity to be listed. Consolidation of promoter shareholding and succession planning. Again, this becomes important, especially for the promoters in terms of rationalizing their structure, their holdings. Previously, they used to hold companies through a maze of companies, and they are now realizing the benefit of simplifying their holding structures. Also, from a succession planning, if eventually they want to move their holdings to a trust, that will, after listing, it will require SEBI approvals and so on. So they are thinking of doing the trust structure first before going for a listing. Increasing liquidity of shares by reducing per share price, and we'll dive a little deeper into this particular aspect of IPOs, where the objective is to reduce the per share price. Now it happens many a times that a company, when it is going for listing, its fair value could be running into lakhs of rupees, and then when it wants to list these shares on the market, it will not be easy to create liquidity when the share price is into lakhs of rupees, because retail shareholders will typically not be able to buy and sell these shares. It will be slightly illiquid. So the way in which companies have approached this is that they have reduced the per share price to 1 or 2 ways. And the most common way to reduce the per share price is through a stock split. Now, when it comes to a stock split, there are inherent advantages from a tax perspective, because stock split is not considered as creation of a new asset. So you get the holding period from your original date of acquisition of the shares, even from a treaty grandfathering and from a GAR grandfathering perspective, where the relevant date is of acquisition or investment is 1st April 2017. As long as your original shares were acquired before that date, a stock split will not really create an issue from a GAR or a treaty grandfathering perspective. But again, this on its own may not be sufficient in order to bring the per share price down to a significant level. So for example, if a share has a fair value of 50 lakh rupees and the par value is 10 rupees, even if you divide it by 10 and make the face value 1 rupee, your per share value will still be 5 lakh rupees, which is very, I mean, for retail investors to participate, it's not very liquid. So you then have to combine it with some other options like issue of bonus shares or a rights issue, or if the promoters or any other investors have convertible instruments, then conversion of those instruments into shares. Now, each of these options will have their own tax challenges and controversies. So if you take an example of bonus shares will basically mean that new shares are getting created today, and hence it will impact the holding period gets reset for bonus shares. Your holding period starts from today, and hence if any investor wants to sell the shares, subject to, of course, lock-in and other requirements under the IPO guidelines, then that investor will have to pay a short-term capital gains tax. Also, from a treaty grandfathering and a GAR grandfathering perspective, these are unlikely to be grandfathered. From a GAR grandfathering perspective, maybe you may still be able to argue that the original investment was made prior to 2017, and GAR talks of investments made prior to 2017, and hence arguably bonus shares should not suffer, or rather they should be grandfathered for GAR purposes, but for treaty purposes it's highly unlikely that treaty grandfathering will be available. Even for rights issue, it's a similar case. Difficult to basically take a position that GAR grandfathering or treaty grandfathering will be available. Most likely it will not be available. And again, the holding period starts from the date when you subscribe to the rights. This is an interesting case study that we practically dealt with. I'll explain the sequence of events first. There was company X, which was incorporated somewhere in the 90s. It was listed for a period of 12 years, from 2000 till 2012. And then it got delisted from all stock exchanges. Its shareholder was company B, which held 98% shares in company X, and others held 2% shares in this particular company. This is after delisting. Then company B got merged into company X, and company X issued shares to the shareholders of company B, that is company A. Company X was again listed in 2019, and company A wanted to offload some of its stake in company X in the offer for sale during the IPO. Now, the key issue here is whether company A can avail taxation as per section 112A of the Act. One of the conditions is that STT should be paid on both legs of the transaction. So on the sell side as well as on the buy leg. On both the legs, there should be payment of securities transaction tax. Now, STT was not paid obviously on acquisition of company X's shares by company A through the merger process. The question here is, because it was a merger and hence there was no STT payable legally, can company A argue that this leg is satisfied, the purchase leg is also satisfied? On the sell side, obviously it will pay STT because there is STT when you offload shares in the OFS process. And hence can it be argued that company A should be eligible for the beneficial tax treatment under section 112A. Now, there is a notification number 60 of 2020, which has been issued by the CBDT, where there is a negative list of transactions where if STT has not been paid on those transactions, then you can't avail the beneficial treatment under 112A. One of the, so A and B, so there are three categories of transactions, A, B, and C. The C category is basically for delisted shares. And it says that if a company has been delisted and any shareholder acquires those shares when it was delisted till the point of delisting, then even though STT is not legally payable and hence STT has not been paid by such shareholder, the shareholder will not qualify for the exception, and hence 112A will not be applicable. Having said so, an interesting dimension to this is that company A acquired the shares in the merger process, and company B was holding these shares even prior to delisting. So at least to the extent of shares which were held prior to delisting, can it be argued that the shares were held prior to delisting, the holding period gets grandfathered under section 47 because it's a tax neutral merger. And since the holding period gets grandfathered, can it be argued that these shares were not held in this window when the company got delisted, but these were held even prior to the delisting? And hence, can it be argued that 112A should be applicable? Now, here there is lack of clarity in terms of how we look at this particular provision. It says the investment should be made prior to 2018, prior to delisting. Now, acquisition or investment prior to delisting, whether the holding period, because the holding period is to be counted from the day the amalgamating company held those shares, would that mean that the amalgamated company can also be considered as having acquired those shares or having invested in those shares from that date? Looks very unlikely. And the controversy is similar when it comes to treaty grandfathering as well, or GAR grandfathering as well. There is lack of clarity on such mergers, and hence probably company A will not be eligible for this particular benefit. Now, assuming if this argument succeeds, then what will be the tax implications in the OFS? Again, if you look at section 55, it has defined fair value. It basically says that you will get the cost of acquisition or the fair value of shares as the cost of acquisition when you sell shares. Now, fair value of shares is defined in section 55, but the scenarios which are enlisted in section 55, they don't cover an OFS kind of a scenario, because in OFS, the shares are not listed when the promoter sells the shares in the IPO process. So although STT is payable, the shares are not listed, and hence it is not covered in any of the scenarios which are covered in the definition of fair value for the purposes of section 55 2AC, which leads to an interesting interpretation issue. Can you say that the competition mechanism fails and hence you basically don't end up paying any taxes in an OFS? Or the other interpretation could be that for fair value, you don't look at the definition which is provided in section 55 2AC, but you look at the definition under section 2, which is a general definition of fair value. In either scenarios, the conclusion would be that the promoter will not end up with any tax liability in an offer for sale. Assuming you are not eligible to claim 112A, is there any structuring possible to avail 112A going forward? Answer is yes. You can probably look at merging company X into a different company. Of course, it's a listed company, so it will have, sorry, not company X, company A into a different company, so that the shares are acquired today and not from the prior year, and hence and not during the window of delisting, and hence you should be eligible to claim 112 in that scenario. I'll take a pause here. In case there are any questions, happy to address the questions now, or else we can take it at the end of the session as well. In the interest of time, I'll move on. We'll cover the questions at the end of the session then. The next theme is exits and divestments. Now, when it comes to exits, typically when a promoter exits from a company and the company has a long history, there will be some issues which will be identified in the due diligence process. Those could be tax issues, those could be commercial issues as well. And the investors will typically want an indemnity for all those issues which are covered in due diligence. And ultimately, if it results in a liability, then the investor will want some clawback of the consideration already paid, or some sort of an adjustment, so that the promoter compensates for those indemnities. Now, if you look at a typical indemnity scenario where the claim is settled only after the liability is crystallized. Let's say it gets crystallized after 4 or 5 years, and you have a running escrow for that period, and ultimately the indemnity claim comes up. Then there could be two scenarios. One is where the investor seeks a grossed up claim, the other where he doesn't seek a grossed up claim, because whatever amount is paid by the promoter to the investor, it will the investor will have to pay taxes for it. So he will typically ask for a grossed up claim. If you look at the illustration here on the left, let's say that there is a consideration of 100 rupees, cost of shares is 30, capital gains of 70, and hence LTCG is about 20 for the promoters. So the net of tax proceeds are 51. Let's say there's a liability of 20 which comes up. In scenario A, it will be grossed up to 26.7, and hence the net proceeds in the hands of the promoter will be 51 minus 26.7, which is 24.4. If it's a normal indemnity claim settlement, it will be 51 minus 20, which is 31.1. So an alternative to this is that the promoter agrees that some indemnities which are almost sure to arise in the future, you adjust that in the consideration which is payable upfront, and hence the net proceeds in the hands of the promoter will increase from 31.1 to 38.6 in that option. The other option, because you may not be clear whether a particular indemnity will arise in the future. So typically what we've seen is that, and this works in the case of partial exits and where there is a primary investment happening in the company, in the target company. The investors are issued convertible capital instruments, and valuation is determined based on the indemnities that are likely to arise or that are potentially going to arise. Let's say the valuation is 100 in this example, and the investor and the promoter agrees that there's a potential 30 rupees of liability which could come up. So the investor is issued capital instruments, convertible capital instruments, based on a company valuation of 70, which can be converted into equity shares. Now, if the liability crystallizes, he'll basically get those equity shares. If the liability doesn't crystallize, then the conversion ratio will change, and those shares will get converted at, let's say, 100 rupees if there are no indemnities in that case. So this is much more tax efficient in terms of structuring indemnity claims, and can be explored in deals where such indemnities are potentially going to arise. Upside sharing between a PE and promoter. Again, this is very common in a lot of deals. If one looks at the recent IPOs as well, you'll see that this has been captured in the DRHP. So if we take the example of Sansera Engineering, there is also there are also a couple of other cases. I don't recollect those names. It was in Sona BLW, where a similar kind of a clause was mentioned in the DRHP. If we look at this particular clause, it says that if the amount realized by the investors is in excess of a benchmark rate as agreed in the agreement, then the promoters are entitled to share some of this upside. Now, this upside can be through various ways. Right? One option is that the investor exits, gets the cash, and then gifts it to the promoters. The other option is that he gifts shares to the promoters. And third, again, there could be convertible instruments which would have been issued to the investor and the promoter when the investor invested in the company, because you would have anticipated this kind of a upside sharing when the investor invested in the company, in which case the ratio gets adjusted and the upside goes to the promoters. An interesting tax issue comes in the case of gift of shares. So if the investor gifts shares to the promoter, what should be the holding period in case the promoter wants to immediately sell it, let's say to another investor or during the IPO? What will be the holding period? Now, since it's a gift, the promoter will have to pay tax under section 56 to 10 based on the Rule 11 UA value. and this will be much more efficient as compared to a cash gift. So the promoter pays tax based on the 56,210 value. There is section 49(4), which basically allows you to adjust your cost of acquisition to up to the amount based on which tax under 56,210 has been paid. If you look at section 242A, which defines short-term and long-term capital assets, it says that any transaction which is covered under 49(1) or the circumstances covered under section 49(1, you will get a holding period rollover for those kind of transactions, which basically means that the period for which the investor had held those shares, that holding period will be counted when the promoter sells the shares. But the issue is that the promoter is claiming a higher cost of acquisition under section 49(4), and gift is a circumstance which is covered under section 49(1). So the controversy is whether you can still, even though you are claiming a higher cost of acquisition under section 49(4), for the purposes of section 242A, can you claim that the holding period of the investor should also be counted in the hands of the promoter? Now, if you read section 242A, it only talks of circumstances covered under 49(1), and hence it is strongly arguable that the holding period of the investor should also be counted, despite having a stepped up cost of acquisition in the hands of the promoters. So there could also be a scenario where all the shareholders agree that the promoter has done something great, and hence everyone should compensate the promoter by giving an upside to him. Let's say in the case of an IPO or even any funding round. A typical way to compensate a promoter would be to make a preferential allotment in his favor. But as we've seen from a tax perspective, a preferential allotment, firstly, whether section 56(210) is applicable if there's a preferential allotment. And there has been a flip-flop from the CBDT side. First, they issued a circular saying that fresh issue of shares should not be covered under 56(210). Then they rescinded that particular circular. There is also no particular exception to address genuine business situation, although case laws have covered this aspect and said that 56(210) should not be applicable in those cases. But the controversy is pretty much there, and especially if one looks at the Sudhir Menon decision, it says that if there is a disproportionate issue of shares, then the shareholders who gain from such a disproportionate issue of shares will be liable to pay tax under section 56(210). So if it's a disproportionate issue, there could be tax implications for the promoter. If it's a proportionate issue and some shareholders don't exercise the option of exercising their entitlement, what happens in that scenario? Now, there is a very recent decision in the case of Rajiv Tulsian. It's a Mumbai tribunal decision where the tribunal has said that only because some shareholders did not exercise their entitlement, and hence the shareholding of a particular set of shareholders increased after the rights issue, that should not really trigger section 56(210). But again, this has to be tested under CAR and whether there was adequate genuine commercial purpose behind issue of or abstinence from the other shareholders from exercising their entitlement. What happens if 56(210), what happens if there is a convertible instrument that is issued to an investor or a shareholder based on the fair value of the underlying equity shares on the date of issuance, but the underlying shares themselves are appreciated on the date of conversion. So let's say that today I get a 1:1 convertible instrument where the equity share price is 100 rupees. When it comes to conversion, let's say 5 years down the line, the equity shares have appreciated to 1,000 rupees. Now, should I get 1:1 equity share, or should I get 1 equity share for 10 debentures because the price has increased? And if I get 1:1, is that going to be taxable under section 56(210)? Now here, again, it is fairly arguable that the option itself, so the option to convert the instrument, that option contract itself increases. I mean, in terms of valuation, the valuation of that option contract itself increases over a period. And hence, when I exercise the contract and when I exercise the entitlement, I'm not really getting any benefit, because on one hand, my appreciated option contract is what I'm exercising that, and that is getting extinguished. And on the other hand, I'm getting equity shares. So there is adequate compensation when it comes to issue of these kind of shares or conversion of these kind of instruments. And hence 56 rule should not be applicable. But again, this is an issue which is ripe for controversy, and litigation is likely to happen if such positions are taken. Another way in which these promoter upside sharing agreements can be tackled is by, in a normal situation, one could have issued ESOPs to promoters, but this is barred under the Companies Act. And hence one could look at a partly paid instrument to achieve the same objective. So to take an example, in step 1, the company would allot CCDs to the promoters. There would be an initial call of say INR 10 out of 100, and the promoter will need to invest only a small amount upfront. In step 3, depending on where the fair market value of the shares of the company reach, the promoters can choose to either exercise this option of converting the CCDs into equity, or they can just let it get forfeited. So if the FMV increases and the company calls for the balance amounts, the promoter could take a loan and raise those funds, pay the call, and get the shares. They can sell it and retire the loan. If the fair market value of the company does not increase to that extent, then they may just let it go. The option or the call will not be paid, and hence those CCDs will be forfeited. Then this is an interesting option when it comes to these upside sharing agreements, where a similar objective is achieved with a very minimal investment upfront, and which is also tax efficient for promoters. Divestment structuring. Now let's assume that there is an existing company which has two businesses, business A and business B. Now it wants to divest business B. What would be the potential options for divestment of business B and the related tax implications? The possible options could be slump sale of business B to investor, or you could consider a demerger of business B followed by sale of shares of the resulting company. Alternatively, you can just inverse it and look at business A. If it is simpler to carve out, you can consider doing a slump sale of business A to a new company followed by sale of shares of the existing company. Alternatively, you can even think of demerging business A to a new company and sell the shares of this company. What are the pros and cons in all of these options? Now, slump sale of business B will be easier to implement. It doesn't really require any NCLT approvals. So if there is no luxury of time and you want to achieve particular deadlines while implementing the transaction, this could be a simpler option. But in terms of tax liabilities, the transaction will be subject to capital gains tax. If it's held for more than 3 years, the undertaking is held for more than 3 years, it will be long term, otherwise short term. And the money will come and it will hit the company. So it will get parked in the company unless you do a subsequent dividend repatriation to the shareholders or some other structuring to take the money out from the company. Alternatively, the shareholders may choose, if the shareholders say are belonging to the same family, they may choose to use the company for making further investments. The other option, demerger, is in that sense a little more tax efficient, because if you know the set of investors who are likely to invest or acquire this company, and let's say that this is an IT company, this is an IT business, and it is likely that a listed IT company is likely to acquire this kind of a business, you may think of even demerging business B directly into the listed company, get shares, and then sell those shares, which will ensure that you pay taxes only at 10% if you've held those for 1 year, which since you have the holding period, uh, uh, since the holding period of the share is considered in the process of demerger, even if you sell it immediately after the demerger, you'll be eligible for the 10% tax rate. So this could be one consideration in favor of a demerger. The other is that once the demerger happens, you basically have to sell the shares and you get the cash in the hands of the shareholders directly. So that's another way to look at it. The flip side is that it is likely to take 6 to 9 months, given that it's an NCLT court approved process. And there is also a specific input of the tax office in this process. So you'll need to have good commercial rationale for the demerger, and you'll need to have 6 to 9 months of time in your hands. Probably you can look at this option when you start thinking of divesting the business, even before you have an investor in mind. Moving on to the next theme, which is funding for overseas acquisitions. Now, we have seen recently that a lot of Indian companies have actually acquired businesses or companies outside India. And the key issue when it comes to overseas acquisitions is how to fund those acquisitions. There could be two ways. One is where the company has significant funds in India available for deployment for this purpose, where it can either think of forming a SPV outside India, which will act as the acquisition entity, and it will acquire shares of the foreign company or the business of the foreign company. Now, when it comes to taking funds outside India from India, the instrument in which this particular, the instrument through which these funds should flow to the foreign entity, that needs to be decided. It could either be debt, it could be equity, or it could be a hybrid kind of an instrument. While choosing either of the two, debt or equity, the overall ETR impact obviously needs to be assessed. So let's take an example where interest deduction is not available in the target country on account of either thin cap regulations, where the debt is likely to exceed certain thresholds, and hence the interest on that debt will not be eligible for deduction. Or if it's an acquisition company which is acquiring the shares of the target in a staggered manner and hence not qualifying for fiscal consolidation immediately, which will result in the interest not being available for deduction against the profits of the target company. In these circumstances, debt funding would result in an annual pickup, given the TP regulations. It will result in an annual interest income in the hands of the Indian company without a corresponding deduction. So in these cases, one could consider a different instrument, either an equity instrument or a hybrid instrument, which does not significantly appreciate and hence does not really result in a significant tax benefit when it comes to unwinding the instrument later. Also, availability of underlying tax credit in India could be considered to optimize the effective tax rate. India has a tax treaty with Mauritius and with Singapore, where an Indian company which receives dividends from Mauritius or Singapore is eligible to claim an underlying tax credit, which means that the taxes which are paid in Mauritius or Singapore, or which are payable in Mauritius or Singapore on the profits of those entities, can be claimed as a credit in India. So let's take an example. If you form a Singapore company for acquiring any European company, and the European company earns profits, it pays corporate tax there. Let's say the corporate tax payable is about 20% in the target country. Now, when the target country upstreams cash to Singapore, there is an option in Singapore to claim a complete exemption against such dividends, or there is also an option to consider it as a taxable income stream and then offset underlying taxes against this income. So if the Singapore entity chooses the second option, which is to consider it as a taxable stream of income, then it can basically offset the corporate tax of 20% paid by the target company in its home jurisdiction against the corporate tax payable in Singapore, which is 17%. So effectively, there's no tax which is actually paid in Singapore. The way you would interpret this from an Indian tax perspective is that Singapore had an income which was on which tax was payable in Singapore. It was offset through credits. But given that there was tax payable in Singapore, that tax credit should also be available against the Indian tax liability. So if India receives dividends and the tax rate on those dividends is 25%, then you could argue that the 17% underlying tax credit should be available for offsetting against the Indian tax liability, which would result in a net tax liability of only 8%. So 20% you pay in the target jurisdiction and 8% in India. That's it. And the cash gets upstreamed right up to the Indian holding company level. So these are some ways in which the ETR could be optimized through either a debt or an equity selection. What happens if you don't have sufficient funds at the India level? Then you'll need to raise external debt. The key question then is which is the right entity to raise this external debt? Which entity will be able to service this debt? If the debt is raised at an India level, will interest deduction be available to the Indian company? Now, interest deduction is typically available under Section 36(1)(3) or Section 57. For claiming a deduction under Section 36(1)(3), you will need to establish commercial expediency of this investment and also a very strong business nexus of the Indian company which borrows and makes this investment in the target company. So there has to be a strong business nexus, which could be established if, let's say that the target company is a supplier of the Indian company. So there's a business nexus here. In which case you could claim 36(1)(3) deduction, but it will be fraught with challenges given that it has a higher threshold for claiming deduction in terms of business nexus and commercial expediency. What happens if Section 57 deduction is to be claimed? Again, there we have a cap of 20%. So your interest expenditure deduction cannot exceed 20% of the dividend that you receive from the foreign company. So this is a significant limiting factor for claiming interest deduction. Capitalization of interest, again, although there are case laws which say that interest can be capitalized as part of cost of acquisition of the shares, it is, in my personal opinion, any capitalization of interest after the date of acquisition is unlikely to be allowed. The other option is that debt can be raised at an overseas level with a guarantee from India. So this could result in a tax efficiency where the overseas company is paying taxes at, let's say, 30%, which is the case in some of the European countries. And there is a guarantee fee which is paid to India, and that is taxable only at 25%. So this may be a much better alternative as compared to raising debt at an India level, because you get rid of the complications of interest deductibility. And in certain situations, you can also have some sort of tax arbitrage through this. Let's look at some practical cases. Tata acquired JLR in 2008, and this is the structure that they had adopted. They had raised debt through a syndicate of banks at the UK level, and Tata Motors India guaranteed this debt. So there was a guarantee structure with debt raised at an overseas level. So this debt came into JLR UK. Using this debt, they acquired Jaguar Cars Limited UK and Land Rover UK, these two entities from Ford USA. Subsequently, Tata Motors raised funds through secured NCDs, rights issue, DVR, GDR, and so on, and pushed these funds down to JLR UK to repay the loan. One more acquisition, which was done in 2018, where UPL acquired Arista. Now, this deal was a $4.2 billion deal, which was a very significant deal for making UPL the fifth largest company in this particular space. The deal was financed through a mix of new equity and debt issuance. So UPL had a company in Mauritius, UPL Corporation Limited Mauritius, and this company issued shares to ADIA and TPG, And it also took external debt from banks of 3 billion, pushed this into Arista Life Sciences Inc. for acquisition of this company. The key question here is how does UPL Corporation service the debt going forward? Can debt push down be considered? Typically, when external debt is taken at a holding company or an acquisition vehicle level, either it is followed by merger of the holding company into the target or the target into the holding company, so that debt is efficiently managed and the interest break is available against the profits of the target company. So here, since they have not gone for any merger, and this merger would also have been taxable because there's no exemption for merger of two foreign companies where the shareholder is an Indian company. The way to service this debt is basically through the cash flows of Arista Life Sciences Inc. So whatever free cash flows are generated at the US level, they will be upstreamed to UPL Corporation Mauritius, and debt will be serviced. Alternatively, UPL can also infuse funds into the Mauritian entity from time to time, similar to the Tata structure, and repay the loan. So if you see in both the cases, Singapore, Mauritius, these holding companies have been used in the acquisitions, which typically is the case in overseas acquisitions. Singapore, Mauritius, Netherlands, these are the favored jurisdictions from an overseas acquisition perspective. Formation of a JV. Now, this is a scenario where we have, let's say, two Indian companies who want to come together and form a joint venture, where one party is contributing cash and the other party is contributing assets. For example, land. It's if one party is a developer and the other is a landowner, and they are coming together for a real estate project, this is typically the scenario that we deal with. Now, what are the options available to strike such a joint venture? The first and the most simple option is that you form a new company, transfer land to the company, and the capital gets recognized accordingly in the books of the company, where shares are issued against the land, and one party contributes cash equivalent to the amount to be recognized as capital contribution of each party. Now, this will result in capital gains tax for the party which contributes land. And depending on the stamp duty valuation and the historical acquisition price, this could lead to a significant upfront tax outflow for the landowner company. An alternative to this is that you form a partnership firm or an LLP and transfer land as capital contribution. Now, there is section 45(3), which says that if a partner contributes a capital asset to a firm, then it is taxable. Then the consideration is basically the amount that is recorded in the books of the partnership or the LLP. There could be a controversy if you do the capital contribution at book values. There could be a controversy if the stamp duty value is again significantly higher. Whether section 50C or 43CA, if it's stock in trade, whether that will override 45(3). There are case laws, tribunal level judgments, which have held that 45(3) is a more specific provision in the context of capital contribution to a partnership firm. Before section 45(3) was introduced, as per a Supreme Court ruling, it was in the case of Sunil Siddharth Bai, the Supreme Court had basically held that the consideration is not determinable, where a partner contributes capital asset to a partnership firm, and hence the competition mechanism fails, so no capital gains tax. Since 45(3) was introduced to specifically provide a competition mechanism for contribution of a capital asset by a partner to a firm, it should override 50C. And that seems to be the trend, and that also seems to be the better view. There is a challenge, potential challenge, if the partnership firm itself gets disregarded on account of it not being a genuine partnership. And there are some case laws where the partnership firm has been disregarded. There is a case in the, there is a judgment of the Allahabad High Court in the case of Carlton Hotels, where in a similar situation, it was held that the partnership firm was not genuine. It was merely a device to transfer the land, and hence 50C would be applicable in that case. But as long as the partnership firm is respected, then 45(3) should prevail, and hence there should not be any upfront tax in the hands of the contributing partner. What happens in the hands of the LLP or the partnership firm? Since it is receiving a property, uh, let's say the stamp duty value is 500 and it is crediting the partner's capital account by 50 rupees. What happens to the balance 450? Is it taxable in the hands of the LLP or the partnership firm under section 56(2)(10)? Now, again, relying on the judgment of the Supreme Court judgment in the case of Sunil Siddharth Bhai, and several judgments several judgments under the gift tax law which have followed Sunil Siddharth Bhai, it can be said that the consideration is not determinable in this case, and hence we can't really say whether the firm has paid adequate or inadequate consideration to the partner. Once the computation mechanism fails, 56(2)(10) should also not apply. So this could be considered as a way in which two partners coming together to form a joint venture can contribute their assets and not have an upfront tax liability for a business that they are going to run in the future. The next theme is on IBC, where we've seen a lot of cases where companies find lucrative deals to take over stressed assets and utilize them in a much efficient manner going forward. Now, a typical issue that comes up in such IBC scenarios is write-off of unsustainable debt. Typically, there is a debtor which is not able to pay its financial obligations, and hence it is in the IBC process. There is an agreement between the lenders and the debtor in terms of what is the sustainable debt going forward after the IBC proceedings are completed, and what is the unsustainable debt or the debt which the bankers will take a write-off for. The key issue here is what will be the tax implications when the bankers allow such debt to be written back by the debtor. Now, there could be three options for structuring these kind of deals. In option one, the unsustainable debts will be extinguished and there will be a P&L credit in the books of the corporate debtor. So we have an example here, which is the Ruchi Soya acquisition by Patanjali. It was through this particular option. And we'll look at the tax implications in the subsequent slide. Option 2 is where this is routed through the balance sheet. So there is no P&L credit. The unsustainable debt gets converted into equity, and subsequently a capital reduction would be implemented in order to bring down the equity share capital. There is an example of this kind of a deal as well, where Vedanta acquired Electrosteel. The third option is where there is no adjustment in the books. So the unsustainable debts are purchased and they are converted into equity, so that in the future there can be a tax neutral buyback. So I'll give you an example. This was in the case of Alok Industries. So Alok Industries had a debt of about 22,000 crores. This was purchased by an asset reconstruction company from the lenders. So the debt continues to sit in the books of the company, which is Alok Industries, but with a different asset reconstruction company. Now this can be converted into equity, which means that there will be an equity, the base available for a subsequent buyback will be 22,000 crores. So any repatriations from Alok Industries to its shareholders up to 22,000 crores will not suffer any tax liability. So there should not be any tax implications on the initial purchase by the asset reconstruction company as well as a subsequent buyback. So this is a very tax efficient way in which to deal with such kind of write-back scenarios. Let's look at the first scenario where Patanjali acquired Ruchi Soya and it was through the P&L account. What happens from a tax perspective? How do we look at these three provisions under which potentially taxes could be applicable? So we'll split this into two parts. Whether the loan was taken for acquiring capital assets or whether it was used for working capital purposes. Now, under section 28(4), any benefit or perquisite from a business or profession is taxable in the hands of the taxpayer. We have a judgment from the Supreme Court in the case of Mahindra and Mahindra, which basically says that benefit or perquisite cannot be in monetary terms. And since the right back is in monetary terms, 28(4) should not apply. When it comes to section 41(1), under the PGBP section, under the PGBP head, it basically talks of remission or cessation of a trading liability. So one will have to look at one will have to see whether the debtor in any of the past years had claimed any deduction in the form of interest or for the principal liability of the loan in any year, and based on that arrive at the position whether that component will be subject to tax. Now here there are a few judgments which have not really gone into whether the deduction was claimed in any of the previous years. They have simply said that since the loan was used for working capital purposes, any write back of those loans will be taxable. So this creates a controversy for taxpayers in those in the jurisdiction of those high courts. So it's Delhi, Bombay, basically, where this controversy could come up. And even if you have not really claimed a deduction in any of the previous financial years, you could still be subject to taxation under section 41(1). The third section which needs to be looked into is section 56, which talks of receipt of any sum of money without consideration. Now, if you look at the Supreme Court's observations in the case of Mahindra and Mahindra, I'll read those. It said that waiver of loan by a creditor results in the debtor having extra cash in his hand. It is receipt in the hands of the debtor or assessee. So this was considered as a constructive receipt in the hands of the debtor, which basically could give rise to implications under section 56. Here again, it is arguable that in bona fide cases where there are independent parties involved and there is a corporate debt restructuring plan in place, there should not be any tax under section 56 because there is it is not without consideration. This particular write back is not without consideration. There are strings attached to this particular write back. The debtor has to follow the debt restructuring plan, and if that plan is not followed, there are penalties involved and so on. So if all these conditions are well documented, it can be argued that section 56 should not apply in these cases, especially because 56 talks of receipt of money without consideration. It doesn't say for inadequate consideration. So the adequacy of consideration is not relevant here. It's basically with or without consideration, and hence it is arguable that this is with consideration. There aren't any questions yet. So I'll move on to the next theme, legal entity rationalization. So this theme basically again plays out where either the promoters want to consolidate their shareholdings before or after an IPO, or if it's a foreign group wanting to collapse its holding companies given the BEPS action plans and so on. So what happens if you consider a scenario where the promoter is holding shares in a listed company to a holding company, and this case came up before the Mumbai NCLT in the case of Ajanta Pharma, where Ajanta Pharma promoters were holding shares in Ajanta Pharma directly as well as through a company, GABS India, and they wanted to merge their holding company into the listed company Ajanta Pharma. The rationale given was that they want to simplify the group structure, get rid of multiple holding tiers and so on. Now, interestingly, the NCLT applied GAR while giving its ruling, and it said that the promoters and GIPL were avoiding taxes by this mechanism. If GIPL would have sold the shares of Ajanta Pharma, it would have paid taxes, and when it would have upstreamed this cash to the promoters, the company at that point of time, it would have been liable to pay dividend distribution tax as well. So by collapsing the structure, by merging gaps into Ajanta Pharma, they are evading taxes, and this is a fit case for GAR, and it is not in public interest, and hence the scheme was rejected. Ajanta Pharma then went to the NCLT, but subsequently they withdrew the application. So as it stands, this particular NCLT ruling applied GAR and rejected the scheme of merging a holding company into a listed company. Let's look at a similar case which happened at the Delhi NCLT. Now here in NIIT's case, again, there were two families holding shares in NIIT through their own holding companies. So Family Trust 1 was holding NIIT through a company by the name PIPL. Family Trust 2 was holding shares in NIIT through GSPL. And they sought to merge PIPL and GSPL into NIIT. Again, similar to Ajanta Pharma, where they wanted to collapse the holding companies of the promoter groups and bring the shares directly under the trust. Here, the NCLT said that it cannot sit over the views of the shareholders and the board unless the views are against law and public policy. And the onus is on income tax authorities to prove that this is a scheme to evade taxes. And this wasn't proven, and hence the scheme is allowed. So again, a similar case, but different result, a different outcome, where the NCLT allowed this. And I would think that the Ajanta Pharma case is an exception to the rule. Typically, NCLT will not really, unless it's against public policy or it's a case of a clear sham or a fraud, it will not really reject such merger-demerger schemes on the basis of GAR or tax. Because in the schemes that we've seen, the NCLT basically says that the assessing officer during assessment is free to review the tax implications of this transaction. And they will not really sit and decide whether it's a tax evasion tool or an impermissible scheme from a tax perspective. In the context of foreign groups who are looking to collapse their holding structures, let's take a look at this particular example where Indian company shares are held by FCO3, FCO3 is held by FCO2, and FCO2 is held by FCO1. There is another group company in the group FCO4, and let's say that pursuant to an overall group restructuring at a global level, FCO2 is sought to be merged with FCO4, which results in change of shareholding of FCO3. From an India tax perspective, what are the implications? So FCO2 will be transferring shares to FCO4, FCO3 shares to FCO4. This is a tax neutral transaction. But because, assuming of course that FCO3 derives significant value from Indian company shares, it will be considered as an indirect transfer. And hence FCO1, which is the shareholder of FCO2, will have capital gains tax implications in India. Now, incidentally, while there is a specific tax neutrality provision for the amalgamating company, there is no tax neutrality provision for the shareholder of the amalgamating company. And hence FCO1, unless there is a relief from relief under the tax treaty between FCO1's country and India, it will be subject to capital gains tax in India. So when it comes to any foreign restructuring, one has to be careful around the indirect transfer provisions in the Indian tax statute. Moving on, let's look at some typical merger-demerger scenarios with a restructuring team that we discussed initially. So this is an externalization theme. This was a demerger scheme implemented by Vyom Biosciences, where the business undertaking of Vyom Biosciences, it was an Indian company. It was demerged into a wholly owned subsidiary in India. The subsidiary, it was a subsidiary of a US company. So pursuant to this demerger, Vyom USA issued shares to the shareholders of Vyom Biosciences. So typically in a demerger scheme, the resulting company, which basically we understand to mean the company in which the business undertaking moves, that company issues shares to the shareholders of the demerged company. But here it was the shareholder of the company to which the business was moved. That company issued shares to the shareholders of the demerged company. Now, this was done with a view to have a particular structure in place where the immediate parent of Vyom India, or the business of Vyom Biosciences, is basically a US based company. It could be with a view to attract foreign investors and command a better valuation. But what happens from an Indian tax perspective? Is this really a tax neutral demerger when it comes to section 219AA? Does it qualify as a demerger under the Indian Income Tax Act? Now, if you look at the definition of a resulting company under the Income Tax Act, and I read out the definition, it says resulting company means one or more companies. So it basically covers even multiple companies, including a wholly owned subsidiary thereof, to which the undertaking of the demerged company is transferred in a demerger, and the resulting company, in consideration of such transfer, issues shares. So clearly here, it was a case of Vyom USA holding 100% shares in Vyom India, and the undertaking was transferred to Vyom India. So as per the definition of resulting company under section 241A of the Act, even Vyom USA is a resulting company, and hence it could issue shares to the shareholders of Vyom Biosciences India. So this structure is used where there is a need to externalize shareholding, or even in the case of listed companies where you don't want multiple listed companies, you want the listed company to issue shares. Even in those scenarios, this particular structure has been used and can be used in a tax neutral manner. And moving on to the next scenario, where again there was a demerger of Tata Chemicals. The consumer division was demerged into Tata Consumers, and this was done with a view to unlock value. And as it can be seen from the market capitalization pre and post demerger, there was a significant value unlocking through this demerger process. The question is, what should be the cost of acquisition of shares of Tata Consumers? So the shareholders who held shares in Tata Chemicals, they received shares in Tata Consumer. What should be the cost of acquisition? Now, Tata Consumers has issued this particular communication to its shareholders, basically stating the proportionate value of assets that have been transferred in the demerger for the purposes of section 49(2)(c) and 49(2)(d) to split the cost of acquisition. So the value that was shifted in the demerger was only 0.66%, and hence under 49(2)(c) 2D, only 0.66% of the original cost of Tata Chemical shares will be considered as the cost of Tata Consumer shares. Now the question is whether it should be the historical price or whether it should be the 31st Jan 2018 price, which should be split in the ratio of 99.34 and 0.66. So price on 31st Jan 18 was 290 for Tata Consumers and 718 for Tata Chemicals. Let's say the actual cost for a particular shareholder was 200 rupees. The question is, should the per share, the cost of acquisition for such a shareholder in Tata Consumer, whether it should be 1.32, that is 200 into 0.66%, or whether it should be 4.74, that is 718 into 0.66%. Now, there is no clear guidance in section 112A and section 55(2)(ac). The communication also specifically points to section 55(2)(ac), although it falls short of giving a view for the shareholders, which is obvious. The company will not really give you the tax position. But based on the intent of this provision and case laws in the context of mergers, where in the past such cost substitution was allowed, even though a section did not expressly have a provision for it, the better view seems to be that the 31st Jan 2018 price should be split in the ratio of 0.66 and 99.34. So the cost of acquisition should be 4.74 and not 1.32. Another interesting dimension could be where let's say that the demerged company has negative net worth. In that case, how do you split the cost of acquisition? Again, there is no answer to this question in terms of any judicial precedents or any express provisions of the Act. A view could be that the competition mechanism fails, so you don't split the cost at all. The cost is retained with the shares of the demerged company, and there is no question of application of this particular provision in the context of listed company as well, and hence you stay with the full 100 for the demerged company. But this could lead to some unintended tax consequences as well, especially because the shareholder may not be able to use the full price of 718 if the price is not split between the demerged company and the resulting company, because as per 112A 55 AC, the cost is restricted to the gains that the shareholder derives. So you don't get the full fair value of the shares if there are no gains. If the gains sit in another company or pursuant to sale of shares of another company, you may not be able to utilize the full cost of acquisition or the full fair value of the shares. The next example is of Sun Pharma. Sun Pharma demerged certain business undertaking out of its Mauritius company. It was an indirect subsidiary of Sun Pharma India, and this particular undertaking was demerged in 2017. And since it was an indirect subsidiary and there is a corporate law restriction in terms of issuance of shares to your own subsidiary, no shares were issued pursuant to this demerger. The question is whether this demerger is tax neutral. So if you look at section 219AA, there is a specific provision that the existing shareholders should become shareholders in the resulting company, but the shares which are held by the resulting company or by its subsidiary, those shares are to be ignored for this purposes, and hence this arguably should satisfy section 219AA requirements, even though no shares were issued pursuant to this demerger. Subsequently, they merged Sun Pharma, the same Mauritian entity, into Sun Pharma India. Again, because it was an indirect subsidiary merging with the parent, no shares were issued, and hence again the same question whether this qualifies as an amalgamation, and what will be the implications for the shareholder and for the amalgamated company. Since the Mauritian entity also held shares in various subsidiaries, all these investments also moved to Sun Pharma India without any consideration from Sun Pharma India in the form of issuance of shares. So is this taxable under section 56? So here again, if you look at section 21B, there is a specific exclusion for shares held by the amalgamated company or by its subsidiary. So again, even though shares were not issued pursuant to this merger, given that 21B does not require issuance of shares in these kind of transactions, the definition of amalgamation should be satisfied. But when it comes to shareholder level exemption, there is no exclusion for shares held by the subsidiary of the amalgamated company. So there could be potential of litigation, although it can be argued that in this particular case, the shareholder did not receive any consideration at all, and hence there should not be any tax implications for the shareholder, which is Sun Pharma Holdings Mauritius. When it comes to section 56, previously there was no specific exemption under section 56 to 7A for these kind of transactions, but now there is a specific exclusion for transactions which are referred to in section 47(6). So any transfers of capital assets from an amalgamating company to an amalgamated company is exempt under section 47(6), as long as the amalgamated company is an Indian company. And this particular provision, there is a carve out under section 56 for these kind of transactions. So it can be said that even under section 56, although Sun Pharma India has not issued any shares, given the specific provisions and the exclusion under section 56, there should not be any tax implications for sun farming. Let's look at one more case study. This is the last case study where we have company A and company B. Company A has accumulated tax losses in trading or distribution business, and company B is profit making. Now, it is proposed that company A and company B should be unified so that amongst other benefits, the tax losses of company A are also available for set off against the profits of company B. So what could be the options here? Option 1 could be merger of company A into company B. But here the losses may not be transitioned, as trading or distribution business does not really qualify as an industrial undertaking. So under section 72A, if business losses of the amalgamating company are to be transitioned to the amalgamated company, the amalgamating company needs to have an industrial undertaking. This requirement will not be satisfied here, and hence the losses may not get transitioned. Here again, if there is unabsorbed depreciation in company A, there are case laws which say that even though it is not an industrial undertaking, and hence the unabsorbed depreciation will not get transitioned, company B can claim a higher WDV in terms of the assets that are taken over from company A, because the depreciation was never actually allowed. And if you look at the definition of unabsorbed depreciation in section 72A, it talks of depreciation actually allowed to the taxpayer. So since depreciation wasn't actually allowed, even if the amalgamating company doesn't have an industrial undertaking and merges with a different company, the amalgamated company should be eligible for a higher WDV. The second option could be merger of company B into company A, where again one will need to justify the commercial rationale for such a merger, especially if company B is significantly larger in size as compared to company A, and hence the tax officers challenge the direction in which the merger is happening. One will need to justify that. But even in this case, if the change of shareholding of company A is more than 49%, there could be a trigger under section 79. Hence, one will need to plan this merger by either issuing preference shares so that there is no change in voting power by more than 49%, and hence the losses continue to be available to company A. Also, there will be stamp duty cost, higher stamp duty cost, given that company B is a larger and profitable company merging into company A. So all these factors will need to be balanced out, and based on a cost benefit analysis, ultimately the decision will have to be made. The third option is, can one consider demerging the trading or the distribution business from company A into company B? Unlike the tax loss transition provisions for an amalgamation, in the context of demergers, there is no requirement that the demerged undertaking should be an industrial undertaking. So even if it's a trading or a distribution business, the losses will get transitioned to company B as long as the demerger is tax qualifying demerger. And also there is no requirement for company B to continue this loss-making business of company A, unlike the requirements of section 72A, which talk of production levels to be achieved and business to be continued for a certain period of time. So depending on the cost benefit analysis and what seems to be implementable in the context of the specific facts of these cases, one can consider either option 2 or option 3 for transition of losses. If it's heavily unabsorbed, if it's a case of heavy unabsorbed depreciation, even one may be workable, but depending on whether you need the unabsorbed depreciation immediately or whether you're okay with a higher WDV in the form of depreciation to be claimed in the future years. So with that, to conclude, I think going forward, given that we have GAR in the statute book, structuring needs to be backed by commercial rationale, And not just that, it should be adequately documented in the form of transaction documents, be it agreements or board resolutions and so on, so that any potential allegations are taken care of. One should rely on specific exemptions provided in the Act when it comes to restructurings, rather than relying on first principles and claiming a tax exemption. So as far as possible, try and fulfill all the conditions which are prescribed for claiming a specific tax. Then timelines and transaction costs for any restructuring will have to be balanced with the tax benefits and commercial advantages and disadvantages. I think uh, there is going to be significant business in the coming days, and some of these themes will continue to play out, be it IPOs, be it externalization, be it shift of residency, or even internal restructurings. These will continue to happen, and we should be able to balance out the tax benefits and the commercial requirements of the transactions in order to have a win-win situation for companies undertaking the restructuring. With that, I'll conclude this presentation.
What is your view on slump sale read with section 184 of the Companies Act, Salora case, where the shareholder determined the consideration should flow directly to them?
Right. So, so Salora case was a very unique case where it was clearly spelled out that the consideration will flow to the shareholders and not to the company. And in a normal case of a non-tax neutral demerger, where you don't have this kind of a language where it is not mentioned that the consideration should flow to the shareholders instead of the company, there I think there is still an argument possible that there should not be any capital gains tax to the shareholder or the company, because there's no provision to tax even a non-tax neutral demerger. Again, there is a high likelihood of litigation in non-tax neutral demerger situations, but there is clearly no provision to tax these kind of transactions unless there is invocation of GAR, and hence, even if you don't have this kind of a language in your scheme, the tax authorities are able to recharacterize the scheme and say that this was a consideration, this was a slump sale, or with consideration flowing to the shareholders, and hence they either try to tax it as capital gains plus dividends or in some other manner. So barring those kind of GAR situations, I think even for non-tax neutral demergers, there should not be any tax implications for the shareholder or for the demerged company.
And the other question is, would Beyond type of structure now be permitted after RBI and companies' rules on foreign demerger being notified, which refer only to cross-border mergers?
Yeah, so here it was a case of an Indian company demerging its business undertaking into another Indian company. The only novel aspect is that the shares were issued by 100% shareholder, which was a foreign parent. And even in that case, the companies approached RBI and took a specific approval from the RBI. And there were certain conditions which were also prescribed by the RBI in its approval. For example, if there is any dividend that is flowing from the resulting company, the Indian company, and which is indirectly attributable to the Indian shareholder, then that cannot be paid to the foreign shareholder. So these kind of restrictions were put in place by the RBI, and it was an approval subject to all these conditions. So even today, if such a scheme is to be implemented, it is very much possible legally, subject to RBI approvals.
In case of gift of shares, there is an argument that no stamp duty is payable. Since the wording used are consideration, what would be your view?
I'm not a stamp duty expert. What I have seen is that even in case of gift of shares, stamp duty is payable from the market value of the shares that are being gifted. I haven't really come across a situation where there is a gift of shares and no stamp duty has been paid.
I have a question in respect of offshore trusts. So, of late, we have been experiencing situations where there are Indian beneficiaries for whom offshore trusts have been formed. And the reason may not be tax saving. The reasons could be easier investment in foreign securities, or maybe some other foreign venture. So in these kind of scenarios, do you think that GAR will throw up an issue? Because ideally there is a commercial rationale, but there are other routes also available to achieve that commercial rationale. So there could be a questioning in respect of why this route was selected.
It all depends on how the trust was formed, who formed the trust, when was it formed, under what circumstances, and so on. So I think all these factors will need to be reviewed. Was it a case of an Indian resident settling a trust for his children when they were non-residents and they have since returned back to India? We've seen those kind of trusts also getting formed, which are legally valid even under the FEMA regime, because under LRS you can set up you can actually gift. This is like a gift of money to your children, but through a trust mechanism. And since they were non-residents, they were not residents at that point of time, it is allowed under LRS. So these kind of trusts are clearly valid, and they'll have a commercial or a valid reason as well for setting up these kind of trust structures. The question is really under what circumstances it got settled, who settled it. Is there any primary motive to derive a tax benefit? Or was it for commercial reasons, genuine reasons for family succession and so on? So if you're able to bring all these considerations on the table and basically prove that it was not merely for tax purposes, there were genuine reasons why this trust got settled. The beneficiaries may have since returned to India, or they may, after a few years, even decide to migrate outside India. Don't know. So these assets may never actually get taxed in India at all. Even if the trust wasn't in place, if you had gifted certain foreign company shares to an Indian resident, and the Indian resident would have migrated outside India, he wouldn't have paid taxes in India. So it all depends on the circumstances in which the trust got formed, what is the current situation, what kind of assets are there in the trust, are there Indian assets, and hence are you claiming a 10% tax rate, or are you wanting to claim even a nil tax position if the trust is a Singapore trust owning old assets which were held from 2017 or before. So a lot of factors will, I think, need to be reviewed from a GAR perspective, and overall from a FEMA feasibility and from a tax feasibility perspective.
Yeah.